Hello investors, today is Tuesday, April 19th. My name is Gary Luna. This is Adam Carlini. Grant Haddon is behind the camera. We are Dynamic Wealth Management, and good to be with you on another video update of what's going on in the market, the economy, and obviously one of the big things that just came and went, tax season finally is over. So
nice to have tax season behind us. Probably nice to have it behind you too. Going forward, if you have an interest in doing some tax planning on your own, you can click on this email we sent you with the video. You can get this downloadable sheet. It's got some good tax information. If you'd like to meet with us and do some tax planning, we invite you to give us a call or an email and set that up, and we can help plan for the coming year. Make sure that you're tax efficient.
Yeah, when you're actually sitting down to do your taxes, probably too late, right, Adam?
That's right. Need to plan ahead. Plan ahead and work your plan.
Absolutely. So with that, let's go and jump into the charts, give you some more information on what's going on.
All right, so let's get to our market update here for April 19th, 2016. Again, we are Dynamic Wealth Management, and Dynamic Wealth Advisors is our registered investment advisory. For those of you who have not yet become clients, we invite you to come to our Investments for Breakfast this coming Tuesday, April 26th. Gives you an opportunity to get to know us a little bit, to ask questions, and it's an open forum. We have both clients and potential clients who are curious to know more about us that come. We'll have coffee and Danish there. The next one after that will be May 10th. If you'd like to come to a more formal setting and see a little bit more about our philosophy and how we work, then we invite you to come to our investment seminar out at Sun City Festival. That'll be April 21st. That's this coming Thursday at 9 a.m.
9 o'clock.
And so, again, same thing. There'll be some coffee and Danish there. So look forward to seeing you there. Please give us a call so we know what to expect and how much food to have. Looking at our risk indicator, our market risk indicator right now is still in the green area, still bullish, surprisingly, and market continues to move up, even though on lower volume in the face of a lot of negative news and weak and not really great earnings. It appears that the market's become the only game in town. Maybe stocks are the new bonds at this point. So, looking at the economy, then we just got past tax season, as you know. Just out of curiosity, you may wonder, how much does your taxes represent as far as your total income and expenditures? So Gary was able to find this nice little graphic. It shows that actually your state and local taxes and federal taxes is greater than the average cost that people spend for their housing, their clothing, and their food. My goodness, if we could get rid of taxes, think of all the homeless people we could take care of with all that money. We could house and clothe a bunch of people. On the other hand, the other thing to think about here is your largest expense is taxes. If your current financial advisor is not discussing ways to cut your tax returns, to reduce your tax expense and make your portfolio more tax efficient, then he's missing a huge piece of planning that you ought to be doing. So we invite you to give us a call and come meet with us. We can share with you a number of strategies to help reduce the tax bite in your life so you have more money for these other things and for vacation and leisure and things that matter. Looking at some of the news this past week, there was the big market-moving news was supposed to come out of Doha, where there was a meeting to discuss freezing oil prices or oil production, and really nobody felt like anything positive was going to come out of it because, number one, we don't really have a lot of companies that are working or countries that are working together on this. Everybody's got economies where they need money, therefore they need to sell a lot of oil, and nobody wants to reduce their production. They all want the price to be higher, but to get the price higher means they'd have to do something in concert with one another to reduce production, and there's just not enough countries willing to do it. And even if they were, we've got Iran as the new big producer who's come back online now that the sanctions that the U.S. have been lifted against them. They've begun to ramp back up their production, and they want no part of stopping production. They want to ramp it up because they've been hurting financially. And so without Iran taking part in this agreement, really nothing was going to happen. The interesting thing, though, is although it says in this headline, oil prices fall on failed oil deal, they quickly snapped back, and oil prices began to move back up. So that's maybe the big shocker. The question that will remain to be seen is, was that bounce back short covering? Because a lot of people were thinking nothing was going to come from this meeting anyways, and so they were selling oil down. And maybe we got everybody all on the same side of the trade. Everyone was shorting oil, and it didn't have much further to fall, and so they covered. And so we got a short covering bounce, perhaps. Or is there something else going on? Is economic activity picking up and just not showing up in the normal places where we look? And is it possible that oil has bottomed? It would seem from all the supply that's available that Iran can fill that excess supply, and therefore oil prices are not likely to continue to rise and shoot back up. On the other hand, there has been some supply destruction recently. Can't think of it off the top of my mind who it is, but one of the major producers has some political issues going on that have scuttled things, as they've got workers that are striking, and the striking workers means less oil supply. So for the time being, that's helping. Maybe that's a temporary thing that's helped lift oil prices here as well. The other interesting thing, though, is oil prices that were moving in concert with the stock market, and the stock market with oil prices, that began to diverge. Now they've come back together again. Now, looking at interest rates and the Fed, we've got another Fed meeting coming up April 27th. The chance of a rate hike at this meeting is about 2% currently. The next meeting after that would be June 15th. The likelihood of a rate hike at that meeting is only 17%. So with the less likelihood of rising interest rates, the dollar has weakened substantially, and Gary will talk more with you about that. A weaker dollar actually helps the stock market. And again, with bond interest rates around the world at very low levels, perhaps the stock market's moving up just as being the only game in town. So with that, we'll turn some time over to Gary to look at the charts and take you through what's going on.
Okay, folks, good to be with you. Adam did a great job of getting us to this point. Speaking of oil, let's take a look at the charts. Last time we spoke to you a few weeks back, we had what was known as a negative divergence, where it looked like finally we were going to have a decoupling between the stock market, which is the green line, and oil, which is the black line. Well, that did not last very long, because you can see that oil did pick up again, and again you can see the high correlation, positive correlation, between the stock market and oil. Now with oil picking up, the latest somewhere around $42 per barrel, and the stock market continuing to do well also. What is one of the things that is driving that price action and driving the stock market is the slowing dollar. As you can see, over the last 3 days, the dollar again dropped on the dollar index. So what this chart tracks is the dollar compared to 6 other major currencies. Obviously, you can easily see there that the trend has been down as we go back to the beginning part of the year. And with a weaker dollar, that is good for our multinational companies, those that are in the S&P 500, including emerging market countries as well for their stocks. In fact, we'll take a look at year-to-date those different sectors. So year-to-date, here you are, we're comparing different asset classes, and we're trying to ask the question, is it a risk-on or risk-off year so far? We've really had a mixed bag. Remember, we started the year very poorly. In fact, it was one of the worst years in history, or the worst year, I should say, in stock market history. So where do we stand now? Well, we stand at a conservative U.S. stock market up about 3.5. International developed countries around the world, as far as that index, up lower than that, about 1.8. Emerging markets have done much better. And as we talked about with the dollar being weak, that has done well for emerging markets. Real estate has done well, 6.3. High yield bonds at just below 5. Commodities have picked up as well, with energy doing better. But also notice, so those are your more risk-on, aggressive asset classes. But gold has done still well for the year, up 17%. And notice Treasuries has done well. In fact, the long-term bond up about 9. So really a mixed bag across the board. Definitely not a a strong move on the risk off or risk off side. What about sectors? Let's take a look. Your leading sector year to date is now energy, with oil picking up. And your lagging sector is actually financials. But financials and healthcare, although they are your conservative sectors over here, actually they have done well of late. Financials was down much more. But your leading sector is still utilities, which is the most defensive sector. So again, a bit of a mixed bag when we look at sectors, but most sectors now in the positive year to date. Let's take a look at the S&P 500. Here's our daily chart. There's that strong rally that we've been on. Anytime you have price action that is dancing on top of the 10-day moving average like that, that's a strong move. It looked like the market was going to take a break here for about 2 weeks. We went sideways only to pick up again last week. So last week turned out to be a good week. And we are getting near the areas where potentially we might hit new highs, and that's what everybody's looking for here. But we still haven't had a decent pullback through, since about mid-February, and that's worrisome. Usually a healthy market is going to have some pullbacks, and we have been looking for that, and notice that has been still on weaker volume. So although the rally has been nice, still a number of things that we're concerned about and we're watching for. As we look back on a weekly chart, so now every one of those candlesticks, as they call them, are a week in time. Notice here's the rally, and finally we are breaking out of this trend that we have been on since really the middle of last year. Is this now a brand new trend upwards? Again, what we're looking for is probably a breakdown to test and to go from there and see what's going on. In fact, if we look at some of the different indicators that we use, this is called the McClellan oscillator, and it many times gives us an indication if we are overbought or oversold. Well, potentially with this strong move, we are getting to the overbought area. When that happens, that should give us another opportunity to potentially put more money to work. As Adam talked about, and as our message continues to be, a lot of fundamentals things that we're worried about underlying this rally. So price action has been good, but number of things, including earnings, including valuations, including the economy in general, that we're concerned about. So we want to respect this strong move in the stock market. At the same time, we want to be cautious and be ready to get more defensive if this thing stalls and we go the other way. So that's an indicator that is to be watched as well. So in our model allocations, as we said, we are now into the green zone. We are bullish, and we've had some sideways action over the last 4 weeks, but we have to respect that to some degree, and we have done that. We have put more money to work over the last couple weeks, and we plan on potentially doing that more as long as we stay in that green zone and continue to be on the bullish side. We'll let the market dictate to us what is appropriate. So a reminder on those allocations, depending if you're a growth, moderate, or conservative client, you can take a look at those percentages between risky assets and defensive assets. And that's really our game, right? We're trying to advise our clients and trying to be very selective as how we put money to work, depending on what market action is dictating. Also depending on the client's personal risk tolerance. That also comes into play as to what we would term as wise investing, and the probabilities of what's going on in the marketplace. That finalizes our video for this week. We thank you for tuning in. Again, a reminder that tied to this email will be a PDF that will be a bit of a update on 2016 tax rates, schedules, and contribution limits. Take a look at that. Hopefully that will provide you some interesting information as to changes for the tax year 2016, so you can make some good tax strategy decisions. And as always, if you need help, please give us a call at 623-466-6060, and we'll look forward to talking to you again in the week to come.